Welcome to Module 21 of Accounting 5000. In Module 21, we're going to go through Chapter 11 of your textbook, and we're going to talk about financial statement analysis. We've already touched on financial statement analysis a couple of times through the semester so far, but in this chapter we concentrate on all the different measures that we use to analyze financial statements. Let's start out by reviewing some of the ones that we've already discussed. We discussed liquidity measures earlier. Remember, we talked about working capital, current ratio, and quick ratio. And I've told you those are very important. You need to know those, memorize those. All of the measures that we talk about are shown in your book on pages 393 through 396. I do not expect you to memorize any of the ratios except the three that are shown at the bottom of this slide. The others you can refer to your book to find. There's some detail about each one of them. But we're going to discuss briefly each one and then work on an example of how this impacts an investor's or creditor's decision. So you know the liquidity measures. So let's talk a little bit about the activity measures. The activity measures that you need to be familiar with are total asset turnover. This is something you've probably seen before, where you take sales and divide it by average total assets. Anytime you see the word average, you know you're going to add two numbers together and divide by 2. The number of days sales in accounts receivable is something that you haven't done before. All you do here is take your accounts receivable number and divide it by your average days sales. Your average days sales is simply your total sales divided by 365. Accounts receivable turnover is your sales divided by your average accounts receivable. Again, average, you take two numbers of accounts receivable, beginning and ending balance, and divide by 2. Profitability measures include such things as your inventory turnover, which is cost of goods sold divided by your average inventory. The number of days in inventory is simply your inventory divided by your average days cost of goods sold. Your average days cost of goods sold is cost of goods sold divided by the number of days, usually 365. On page 378 of your textbook, if you look through there, they give you some examples of the accounts receivable turnover computation, the inventory turnover computation, and the plant and equipment turnover computation. So there's some examples of how to work each of these as you go through and talk about the different measures. Profitability measures. A lot of these you've already worked with. ROI, you know that one. Net income over sales times sales over average total assets. ROE, you already know that one. Net income divided by average owner's equity. A couple of new ones here. PE ratio. The PE ratio is the market price of a share of stock, which you can find pretty much anywhere in the newspapers or on the web, divided by earnings per share. So you're going to use your earnings per share and divide it into your market share for each share of stock. That tells you the ratio of earnings to the price that it's going to get you. Your dividend yield is simply your annual dividend per share divided by the market price of that share of stock. So that tells you your investment in the market price gives you what kind of return, and that return would be your dividend. Additional profitability ratios would be your dividend payout ratio, which is simply your annual dividend divided by your earnings per share. So if a stock earns so much earnings, how much of that do you actually receive in dividends? And then finally, your preferred dividend coverage ratio. This simply is your net income divided by your preferred dividend requirement, and that tells you how many times your net income can cover the preferred dividend that you have to pay. In your financial leverage ratios, this is again the use of debt. Remember, debt implies risk, so companies try not to have a lot of debt. If you look at Microsoft, you can see that Bill Gates does not assume much risk at all. He has very, very little debt in Microsoft. But other companies have to use debt in order to finance their operations. So we do an analysis as investors and creditors by looking at their debt ratio, which is total liabilities divided by the total financing through liabilities and equity. Then we look at the ratio between the debt and the equity. How much of our financing came from debt, how much from equity, what's the relationship? And then finally we look at the times interest earned, which tells us how much of our earnings can we pay out in taxes and interest? Excuse me, just interest. That EBIT that you see on that slide stands for earnings before interest and taxes. And you can compute that by taking net income, adding back your income tax expense, adding back your interest expense, and then dividing by your interest amount. A couple of other things you might want to look at besides financial ratios, which is what we spent most of our time talking about, are a few things like book value per share of common stock. If you take all of your common stockholders' equity and divide it by the number of shares of stock you have outstanding, that tells you what each share of stock has in the company as pertaining to book value. Now remember, book value may be different from actual fair market value, but it gives you a ballpark on what the actual value of the stock is according to the accounting statements. Another interesting technique is called common size financial statements. This is interesting because using common size financial statements, you can compare firms of different sizes. If you're just using percentages, then percentages don't matter as much as dollars do. You could have $1 million and $10, and the relationship, the percentages, would be much more important. When you're doing common size financial statements, you set your total assets to 100%. Every piece of the asset then, cash, accounts receivable, property, plant, and equipment, would be a portion of that 100%. If your assets are 100%, then obviously your owner's equity and liabilities would be 100%, and you simply divide up that 100% among the pieces that go into liabilities and owner's equity. So again, it's a useful tool in analyzing how companies work that are different sizes, so that you can compare a small firm to a large firm and still have a valid measure of how well they're running their firm. Well, let's look at some of these techniques by looking at one problem. Now, there are 3 problems assigned for this chapter. I'm going to work through one of them, give you some helpful hints on the second one, and kind of let you work through them. Because the answers are here, the formulas are in your book, I'm not sure that you need a lot of detail on these, but I'll get you started by looking at one of them and then give you some helpful hints on the other. Problem 11.9 is the one I wanted to work on today. It's on page 403 of your textbook at the very bottom of the page. They have a company they call Wiper, Inc. You'll notice they give you current assets, other assets, current liabilities. Then on the top of page 404, they give you the income statement and other selected data. So you don't really have a set of financial statements to work with, but you have enough numbers that you can compute these A through K items that they're asking for. For example, in Part A, they ask you to calculate return on investment based on net income and average total assets for 2004 and 2003, showing both margin and turnover. You've done this numerous times before. This is just the DuPont ROI model, where you take net income over sales times sales over average total assets. Your net income is shown on page 404 under income statement data. They give you the net income amounts for both years. Your sales are shown in that same box there on page 404. Your average total assets are on the previous page over on the balance sheet information, where they give you total assets for those years. And what you find is that you have an ROI of 6.5% in 2002 and 7.1% in 2001. In Part B, they ask you to compute ROE, return on equity, which, as you know, is net income divided by average owner's equity. Net income you've already found. Owner's equity is an average, so you're going to take the beginning of the year and the end of the year, add them together and divide by 2. Your return on your owner's equity in 2002 was 18.9, and in 2001 it was 19.2. In Part C, they ask you to calculate working capital and current ratio for each of the past 3 years. So they want 3 years worth of data. Working capital is simply current assets minus current liabilities. Those numbers are given in the box on the bottom of page 403. So if you look at the trend there, it went from $26 to $88 to $115. So there's a good trend there in working capital. It's increasing. If you look at your current ratio, it's gone from 1.0 to 1.1 to 1.2. So those are both good trends when you're looking at that information. In Part D, they ask you to calculate earnings per share. Well, as you know, you do that by taking net income and dividing it by the weighted average number of shares of common stock. They give you the weighted average number of shares of common stock in the box on the top of page 404. So you simply take net income and divide, And you find that earnings per share has gone up from 2001 to 2002 by 65 cents. In letter E, they ask you, if Wiper stock had a PE ratio of 13 at the end of 2004, what was the market price of the stock? Well, this is an algebra equation because the PE ratio is equal to the price divided by earnings per share. You just calculated the earnings per share as being 465. They give you the PE ratio is 13. So 13 equals price divided by 465, so the price must have been $60.45. In letter F, they ask you to calculate the cash dividend per share in 2004 and the dividend yield based on the market price calculated in Part E. The dividend per share would be your total amount of dividends divided by the number of shares. Well, the total amount of dividends were $50 and there were 41.6 shares, so each share got $1.21. Now, using that information, we can calculate the dividend yield because we can take the dividend per share and divide it by the price. We got back $1.21 on our $60 investment, so we got a 2% yield. It's not a very good yield there, is it? 2%. In letter G, they ask us to calculate the dividend payout ratio. So what we're looking at there is the dividend per share divided by the earnings per share. In other words, we earned $4.65 a share. How much of that did they give us back in a dividend? Well, they gave us back 26% of it. So they kept 74% and gave the investors 26%. In letter H, they ask us to assume that accounts receivable at the end of 2004 were $309 million. Calculate the number of days in receivables at that date. Well, what you do there is simply take the average day's sales, which is sales divided by 365. You get 8.356 million. Then you take that number, the days sales in accounts receivable 309, divided by that number 8.356, you get 37 days. That means that your accounts receivable, on the average, consists of 37 days of sales. So you have to go for 37 days, which is what, a little over 3 months, to accumulate all the sales that are in accounts receivable. In letter I, they ask you to calculate the debt ratio and the debt equity ratio for 2004 and 2003. The debt ratio is simply your liabilities divided by your total of liabilities and owner's equity. You get 67% in 2002. You get 63% in 2001. The one I use more often, though, is my debt to equity ratio, which tells me the total liabilities divided by the total owner's equity. In other words, what percent of your financing comes from debt? So you find out it's what percent of your debt is related to your liability, is related to your owner's equity. I'll get that right in a minute. In other words, in 2002 you have 207%, which means you have twice as many liabilities as you have owner's equity. In 2001 you were better off. You didn't have quite twice as much. You only had 1.7 times the debt that you had owner's equity. That just shows you the company is using a lot of debt in their financing, and it's getting worse. It went from 174% to 207%. In letter J, they ask you to calculate times interest earned for 2003 and 2004. This simply tells you how many times they could have paid interest over and above what they're paying in now. You take your net income, add back your interest and taxes. Remember, that's that EBIT we talked about before. Divide it by the interest. So they could have had 3.5 times as much debt and still not have had a loss in 2002. In 2001, they could have had 4.8 times as much debt and still not have had a loss, simply by being able to pay their interest. But that trend there doesn't look good because the times interest earned should be larger and it's going down. So that shows you that they're in more debt than they should be or than they have been. Whether it's what they should be or not would be up to the investor or creditor. In K, they ask you to review all of this and then evaluate all that you've come up with and state your opinion about whether you would invest it as a young single professional who wants to invest in common stock. What you're actually going to be interested in here is if there is any potential for growth for the firm and how much risk you're willing to accept. The one thing that might be a drawback on this investment is that it has high leverage. In other words, it has high debt. It may be a good investment, but you have to be able to assume risk. And if you're young, single, you probably can assume that risk. So all things given, looking at that overall picture, this is probably a pretty good investment. The other two problems that were assigned in this chapter were problems 10 and 12. Let's look at problem 10 just briefly, talk about it, and get you started on it. The answers are in your handout, so I don't really need to go through it, but I want to make sure that you understand what's going on. Problem 10, they ask you to use the information from Intel and the appendix, and to compute ROI, to compute ROE, to use the PE ratio, the dividend yield, and the dividend payout ratio. All of that information you have in your book, and you have the formulas in the middle of this chapter, so you should be able to compute those fairly easily. Those are nothing new. In Part B, they ask you to compute the liquidity ratios of working capital, current ratio, and quick ratio. You should be able to do those. In Part C, they ask you to compute the following activity measure: number of days in accounts receivable, number of days sales in inventory, a couple of turnover ratios. In Part D, it's the debt equity, the debt and the times interest earned ratios. And finally, in Part E, there's a little bit of twist on this, some things that you haven't probably had before. In Part E, number 1, they tell you to compute the following physical measures of Intel's profitability as of December 29, 2001. In Part 1, they want you to do net revenues per employee. Well, as you can imagine, what you're going to do is find out what your net revenues were and figure out how many employees there were. Well, if you look through Intel's financial statements, you will find that there, let me find that information. You will find that they had $26.5 million in revenue, and then you have to add two employee numbers together to get an average number of employees. And I got about $313,000 revenue per employee. And then in Part 2, they ask for operating income per employee. So you use the same numbers for the employees that you used in Part 1, and you're dividing that into the operating income of $2.256 million, and you get about $26,000 or $26.6 million per employee. So that's a pretty good ratio there. But those are new ones that you haven't run into before, and that's based on information in the annual report. The last problem that's listed for you in this chapter is problem 12. This is an interesting one that you can use to compare to what you got in problem 9, because in problem 12 you're going to be doing Microsoft's analysis, and you do such things as working capital, current ratio, quick ratio, ROE, ROI. All the things that you did for Intel, you can now compare to Microsoft. So I think that gives you some information to see what the value of these financial ratios is. So you're going to spend some time now going through and computing ratios and looking at the information that you get from those and trying to make a decision about investing in those different stocks. We will start a different focus in this course with the next module. We'll be looking at Chapter 12 in the next module, where we start looking at managerial accounting. So this chapter summarizes, brings together all of the financial accounting information, and we'll start on a different focus in the next module.